Today's webinar. We'll be talking about Fibonacci market analysis, which is organized by A to Z Forex and sponsored by HY Markets. My name is Yakub Rahimov. I'm a professional Forex trader and trainer, and the author of the upcoming Forex book called Forex Not for Dummies. And I'm dedicated in teaching people on how to succeed in Forex market. Just before we start the webinar, I want you to read through the risk disclaimer for just a few seconds. In short though, Forex might not be suitable for everyone because of the leverage involved, and you shouldn't involve the money that you cannot afford losing. If you need any extra assistance, you must acquire a third-party consultancy. Last week we analyzed euro dollar, gold, pound dollar, USDJPY, and USD Canadian dollar. I'm gonna try to keep up the same structure for this week's analysis, and we'll start with euro dollar. I haven't changed anything from my chart point of view, just to show us how the market really reacts to Fibonacci. If you remember, I always tell one thing: you cannot just combine high and low on Fibonacci analysis and expect a miracle to happen. This is not how Fibonacci analysis is done. You need to understand the market, you need to feel the market, and therefore you need to find the true Fibonacci wave. The wave that the Fibonacci is moving on must be the correct wave. I have actually decided to host a specific webinar about the educational part of the Fibonacci analysis, which I'm going to be announcing on a2zforex.com in the coming days. So if you want to join those as well, feel free to follow A to Z Forex webinar section. So let's get back to euro dollar. As usual, in order for us to analyze the market, we need to put it on a weekly time frame. On weekly time frame, we can see that the market retraced back from the 200% Fibonacci retracement zone, and last week I was focusing on that level where the market was supposed to retrace, the 38.2% level I'm talking about, and it did touch and then it did retrace upwards. However, the bullish retracement was not really strong, so the total bullish move we had was only 120 pips, which is still okay for our expectation, for the fact that anyway, when you are aiming the retracement, you don't aim to enter the market on the retracement, but you aim to exit the market on the retracement levels in order to safeguard your entries. So if you were shorting, you did the right job by exiting the pair at 1.07 level, and furthermore you also did the right job by entering a short position below the 1.07 level as well, following the webinar we hosted last week. So where is it that we are looking for, or what is it that we are looking for at the moment? On weekly time frame, we can see that the level of 1.0650 zone is historically for 2015 have been a major support level. We have had back in April a retracement taken place from there on. We have had again in I think it was late March as well, we had the retracement, and so on. This level has been historically a major support zone for us. What it means is that you shouldn't try to enter a position at this level, since there is a possibility or probability that the market is going to be retracing or reversing. That being said, on daily time frame, we can see the significance of this level, since the pair touched it and bounced upwards, and it also is appearing to have found itself another support zone today as well. Fundamentally talking as well, at the moment euro dollar is under pressure, euro is under pressure, giving boost to dollar for the fact that we had a terrible terror activities in France as well on Friday. That's indeed the reason why we saw the the continuation of the bearishness, not bullishness. If it wasn't the fundamental push for euro on Friday, we probably would have had a reversal for Monday, which you anyway saw the result for the beginning of the day yesterday. So at the moment, my expectation is that as long as the pair is below 1.07 zone, we are bearish and our target remains at 1.0550 level, which is 12% Fibonacci retracement zone. However, if we see that the pair is going to break above the 1.07 zone, which is 38.2% Fibonacci retracement zone, our aim will reverse to 1.0980 level, which is the 88% Fibonacci retracement zone. I know these levels are not custom for default for you. These are custom Fibonacci retracement zones, and the reason why it is 10% or 12% or 88% is because of the fact that Fibonacci starts with 1. It doesn't start with 3 or it doesn't start with 2. So it's 0, 1, 2, etc., etc. So this is the way that I'm looking at the market. Now let's look at the gold. Before I even talk about gold on any way, you need to understand one thing. In times of instability, in times of terror, in times of crisis, gold appears to be very volatile. This is the main reason why we had the bullish attack on Monday's market opening. Yesterday the market opened and it shoot up some 150 pips, and then it started continuing downwards as the world showed kind of a unity for the French terror attacks. At the moment, the valuable metal broke below again the 88% Fibonacci retracement zone, and it is pushing towards my major target level. The major target level that I'm talking about is 1060 zone, which we discussed last week as well. And from 1060 level, we will be aiming to go for the 61.8%, which is at 1121 level. So if you are shorting the gold, you should be aiming for 1060, and from there onwards look for buy opportunities at 1121 level. However, you might also see some kind of support zone at 100% Fibonacci retracement zone as well, for the fact that 1074 level has been historic support zone as well. So if we go back on the weekly time frame, you can see that 1074 level have been major support zone for the last many weeks. Well, actually, it's more than a year or more than multiple years that it has been major support zone. This is for gold. Now we are going to be analyzing or reanalyzing pound dollar. I have unfortunately deleted the previous Fibonacci retracement zone, which gives us an opportunity to look at the market from a little different perspective, for the fact that we will be redrawing the Fibonacci retracement zone. And the level that I'm looking for is right at this level, from here to the level of the highest high of 21 June to the lowest low of 5 July, weekly candle, of course. And I'm gonna make it, of course, the ray. You double click properties and make it ray so that it shows for the feature. And we need to check if it is applicable or not. The way we check whether or not a Fibonacci retracement zone is applicable is by looking at the 61.8%. If you see that 61.8% is applicable, which means it has touched and it has acted as a major support or resistance level for a while, that confirms it. And 61.8% as is our confirmation. We have seen the pair acting there. So the level that we are looking for is a true, real Fibonacci retracement level, and it is a true Fibonacci wave that we are looking at. So that being said, we are looking for a sideways market movement, as we discussed also last week. I'm gonna add the rectangle over here to just show us the level that I'm talking about. Overall, this zone that we have is a sideways development level. is a sideways development level. So as long as the pair is within these boundaries, which is between 1.5130 and 1.5250 levels, more or less, it means we will be looking for the market moving sideways. It will be small up and down moves. Therefore, we shouldn't be expecting really much out of the market during these levels. That also is very close to our 138.2% Fibonacci retracement zone as well. So that being said, we might see a small fake breakout testing the 1.51 level and see the pair reversing backwards bullish as well. I'm expecting the market to be bullish for the coming month, for December I'm talking about, but we will see at the end. We don't have a crystal ball to really talk about the time, but we can only see the price confirmation, what is really happening. The reason behind my bullish thoughts about GBPUSD is the fact that the UK is a relatively stable country compared to other countries. Let's say if you compare it to Europe, there are too many variables for Europe. There are too many countries having an effect on the euro. For USD, US as an economy is a global economy. It has an impact on the global economy. Everything happening in the world has direct impact on US politics and US economy as well. So therefore, it might sound strange for you, but USD is also very unstable currency. That being said, the British pound, GBP, is quite stable for the fact that it is one economy. It's a developed economy. Meanwhile, it is not much dependent on the global changes, although there are some effects as well from Europe mostly. And at the moment, since we are moving towards the Christmas period, which is holiday period, we will see the fundamentals faking out or fading out, not faking, but fading out, and it will give us more opportunities that we will not necessarily be looking for negative data. And in times of holidays, especially holiday period like New Year and Christmas, the people start spending. So the data during and after the Christmas is likely to be positive, and the shops will be recruiting. The employment data will likely be going upwards as well. People will be spending, so the consumer spending data is expected to be positive as well. So fundamentally, we are looking for bullishness as well. And the overall, the market is also showing that on weekly time frame, the pair reversed from 150 zone. So if we see that the pair is breaking above the 1.5290 level, we will be looking for 1.5330 zone, which is 100% Fibonacci retracement zone. And from there onwards, we will be aiming for the pair to go higher, and our major target at that level at this moment is going to be remaining at 88% Fibonacci retracement zone. I would put my target a little below it at 1.5385 zone, which is going to be very much close to the 200-day simple moving average as well. So if you are going to be long in the pair, long above the 1.5225 level and aim for 1.5390 zone. This is for GBP USD. Now let's look at USD Japanese yen. Once again, USD Japanese yen is also a kind of is a type of a pair that generally I don't really enjoy analyzing on Fibonacci, for the fact that it is often manipulated by the Bank of Japan, and whenever there is manipulation, technical analysis tends to fail. Now, since we have drawn the Fibonacci, what I did was I connected the highest high of 17th of August to the lowest low of 24th of August, which is a perfect Fibonacci retracement zone or perfect Fibonacci wave. And we are again looking for 61.8%, whether it's acting or not. It is acting. You can see how strong 61.8% is. it's touching and reversing backwards, so we have a perfect Fibonacci retracement zone in front of us. At the moment, the pair is moving towards the 12% Fibonacci retracement zone. My suggestion or my preference would be to sell a little above the 123.85 zone, which is just above the 12%. Actually, the target should be 123.80 zone. That would be my sell target. Or if you are buying, that would be my take profit target for bullish entries. And from there on, I will be aiming for sell orders. The sell orders that I'm aiming for will be just close to the 121.70 level, which is a little above the 38.2%. And the reason behind is not just the Fibonacci, but also the price action as well. The level that I'm drawing right now with the red line, you can see that it is a very strong level. It acted as a resistance before. It has acted almost as a support later as well. You can see this line I'm talking about over here as well. So 121.85 zone should be the targets for your bearish orders or bullish entry levels as well. So you can use it on either position. Wherever it comes or whatever it happens, it is likely that you will see this level being met, and in the worst case, you can use it as a scalping opportunity. These are the four major sections that I wanted to analyze. In the meantime, if you have questions, you can ask, and I'm going to be adding one last currency pair for today, and it's going to be Aussie dollar. So while you are typing your questions, or if you are typing your questions, I'm going to be looking at the Aussie dollar. We need to just find the correct Fibonacci retracement zone or correct Fibonacci wave, and this is the wave that I'm looking for. There it is. So we can see that if the market is acting very much in one direction and you tend to not to be able to see the 161.8% met or 61.8% met, you can look for the either direction. So our qualification is either 61.8 or 161.8, and we can see that for Aussie dollar, 161.8% level acted as a very strong support zone, and therefore we are looking for the pair to move on the right direction on a retracement base. So since the pair moved from 161 and retraced back from 100 level, it is basically 61.8% movement in total. We are going to be looking for the next move from 138.2% to be again 61.8%. And that's going to be approximately 138 minus 61. It's going to be very close to 76.4% level that we are going to be aiming from this level. And it's approximately 333 pips movement. So if you haven't, if you are trying to sell, my recommendation would be stay aside. Don't really try to sell because the market is not really bearish at the moment. We have had higher high and higher low, and the current low is also higher than the previous one. So the price action is intending to tell us that there is a likelihood of moving upwards. So I'm looking for possible bullish entries just above the 0.7160 zone, and my targets will be 0.71.85 level as the immediate targets. This is the target for this week and until the middle of next week. This is it so far for today. Thank you very much for following today's Fibonacci market analysis webinar. The webinar was sponsored by HY Markets and organized by A2Z Forex. If you have any questions, please type your questions and I will be more than happy to answer them. Thank you. We have two questions. The first one is from Sekar Naidu. He's asking why I'm drawing Fibonacci from left to right. And if you draw the Fibonacci from, let's say this way, I'm gonna delete it. If I draw it from left to right, I will not be able to follow the market on the trend direction. That's the main reason I draw it from right to left, because my trend is bearish, so I need to follow the bearish side, which means my extension 150, 161, etc. needs to be below the 100 level or below the lowest low. That's why I'm drawing the Fibonacci from right to left. Otherwise, if I would draw from left to right, as you can see, I have no added value for myself. I can't really see any kind of extension for the Fibonacci. The next question we have is from Sarwar, analysis for Canadian dollar, Japanese yen. I will do it for this time only, although I don't really like trading this pair myself. Let's delete the objects on it, and we'll have to look at the weekly market and we need to find the correct Fibonacci wave. And it appears that this is the correct Fibonacci wave that we have, and there it is. Okay, 61.8% whether it acted or not. We can see that it's almost triggered and it reversed. So it is a correct Fibonacci wave that we are looking for, and we can also see that the market is in sideways development. My recommendation would be sell below the 91.50 level and target as low as 88.40 zone. And if you are buying, or if you want to buy, try to buy above the 92.75 zone, and your targets should be limited at 94.40 zone as well. So it gives you some 160 pips profit opportunity. For each opportunity, if you are buying it, your stop loss should be around 100 pips. And if you're selling it, your stop loss should be approximately 95 pips as well. Okay. This is it so far. Any other questions? Thank you very much for being with us once again today, and I look forward to seeing you in our future webinars as well. Take care, stay profitable, and until next time. Bye-bye for now.